Latha, let me ask you that. Reducing the reverse repo and thereby disincentivizing banks to hold money with the RBI, will that mean some money will get redirected to the consumer financial segment at all in any fashion? Will we see a further reduction in mortgage rates or in auto finance?
The reverse repo is a very, very small input into this. Sure. The psyche of a banker is, will this guy return my money? And so it's really
still risk aversion at this point in time.
And for the borrower as well, you know, the total volume of credit has fallen not only because banks have become wary, but consumers have also become wary. The consumers or the borrower will become confident only when he's very sure that his job is safe, his perks are safe, his salary is safe. Sure. Now, this kind of psyche takes some time in building. When all over the papers you only read about pink slips and about job cuts and capex plans being pulled back, the psyche of the consumer also is not one to go out and increase his EMI commitments.
Sure.
So you have to give that time for the psyche to return to a kind of stability. And that's not going to happen in a hurry, and a reverse repo is just a very, very small ingredient in the whole thing.
Sumant, the risk aversion sort of extends to corporate credit as well. If rates are not going to come down that dramatically, if you have bonds that are a lot more attractive and you have risk aversion when it comes to corporate credit, are you at all hopeful that money will be affordable at any time in the near future over the next month or two?
Well, I can't say if it will change that rapidly, Menika, but I certainly do believe that if the RBI continues in this fashion, it will certainly be helpful for corporates to start getting liquidity. Having said that, I think that banks at this point are extremely risk averse, whether it is in terms of lending to consumers or whether it is in terms of lending to corporates. And given the fact that corporates at this point, whether for refinancing purposes, if not for capex purposes, need liquidity, and they are really the only liquidity providers at this point in time, along with the huge borrowing program of the government, I think banks are sitting very pretty right now, and they can actually demand, in a way, their pound of flesh.
All right, so let me end by getting closing comments from each one of you. Sumant, how much do we need to see rates go down by for corporate India to feel incentivized to borrow in any fashion? If I was to leave the risk aversion out, how many more such rate cuts would you like to see, and how quickly?
Well, you know, I can't really link the rate cuts directly to reduction in corporate borrowing rates, but all I can say is that corporate borrowing rates need to go down by several hundreds of basis points, i.e. several percentage points, I think, before it really returns to levels that we had seen earlier, and where, in fact, it still made sense to go out and do new projects. So I think there has to be a fairly significant reduction, and unfortunately it's linked more with liquidity, availability of liquidity, and the risk aversion mindset of banks than it is that much to do with the RBI.
Mr. Godrej, would you agree that it's now more up to the banks to be able to pass on these lower rates in any substantial fashion to corporate India, as opposed to expecting more cuts from the Reserve Bank?
Yes, I think the Reserve Bank has cut adequately for the moment. Banks could reduce their lending rates. I think the problem is also that they cannot bring lending rates down too much unless deposit rates come down, which could create problems of their own. So I think what is important is we must get banks to lend to corporates and to consumer finance at around 8 to 9% in the present circumstance, and not more than that. But I don't think it will go much below that, because then they would cause a problem in terms of the provident fund rates, the deposit rates, etc. So I think 8-9% is a good interest rate currently. If we can get it to that level, it will be good. And maybe after a couple of months, when inflation is almost at the zero level, that rate could come down to 7 or 8%.
All right, Latha, last word to you. 8-9% from the lending institutions themselves. How quickly do you see that happen, if at all? And do you think we're likely to see any more RBI cuts in the near future? I'm saying in the next 2 months or so.
Well, it'll be a little difficult for the RBI to move very significantly hereafter, because the 3.5% savings rate does become a mental block. If bankers are paying a minimum of 3.5% for a savings account, then, you know, pushing the reverse repo rate below that could disincentivize banks from asking for savings altogether. You know, the expansion of the banking sector itself could stop, and the Reserve Bank does have a soft corner for the savings rate as well, for savers as well.
So RBI cuts, at least in the next 2 months, ruled out unless there's some dramatic changes in the global economy.
Absolutely. And more importantly, whether it will, whether it's enough for the economic growth, well, it's not enough. You know, never has an economy been financed entirely by bank money. You will have to see equity capital getting encouraged. You will have to see global finance start to come. It's going to take a long while for real.
Way out.
Absolutely. So credit, unless that kind of competition comes for banks.
to 9% as Mr. Godrej was talking about?
It'll take actually HDFC, KK Mistry said he is able to borrow at single digits at 9% or thereabouts. It's going to take a little while, but it's not going to be very far away. But I have my own doubts whether that will be enough to propel consumers and producers like Godrej and Mr. Sumant Sinha to borrow in a big way.
All right, Latha, we'll leave it there. Mr. Godrej, Sumant, thank you very much for joining.